Are you sure?
Here's the 30-second lesson on what legends know. Never ask a bride why she's getting married. Don't wear a skirt on a windy day. Deodorant is not a shower. Don't sniff chili flakes. And don't forget, saving is not investing. Legends don't just save, they invest in mutual funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and this time we're going to be talking about the bank credit, how it's been flowing over the last year, but also crucially we're going to examine the question of how much credit is too much credit. So now this is an important question to ask because our economy, we've seen in the past that we have gone through phases where a lot of bank credit has suddenly turned into bad loans. So it's once bitten, twice shy. We need to be careful about these things. And to examine all of this, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, let's start with how has bank credit overall grown in the last financial year, since we have the data for the full year now?
Yeah, so we have the data for the full financial year, and since it's a outstanding stock variable, so if we look at the March data, that tells us what is the credit growth performance in the entire financial year.
Right.
So the credit growth, where we look at primarily the non-food bank credit grew at a rate of 16.3% in FY24, that is in the financial year that just ended, and this was a rise from the previous year. In the previous year, bank credit grew by 15.3%.
Okay, and now let's go into the sectors where bank credit has largely gone. Now, housing loans have been a large growth area in the previous year. Has this continued in the last year? And also, has this growth in housing loans, has it contributed to the rising price of housing, or that there are more luxury houses being bought?
Yeah, so let's first look at the aggregate level. So as I said, non-food bank credit grew at 16.3%, and there it's primarily being led by services, loans to services, and loans to household. That's
Right.
also called retail loans or personal loans.
Okay.
Encouragingly, credit to industries has also picked up in the last financial year, though it's still low, but there is some kind of, if we look at the data, there is bottoming out, and now there is a pickup in credit to industry.
Right, yeah.
So
we will,
So now from personal loans, if we look at within personal loans, we see that almost half of personal loans is accounted for by housing loans. So that is a major component of the overall growth in credit, and housing loans continue to grow at a sharp pace. And here again, one very critical data question is that there was a merger of HDFC with HDFC Bank that happened in July 2023. So before July 2023, we have data excluding the merger impact. After July, we have data including the merger impact. So there is a big jump that we see if we just look at data including the merger impact. So for ease of comparability, it is important that we look at data excluding the merger impact for this financial year as well.
That makes sense.
So if we look at data excluding the merger impact, housing loans have grown at a pace of 17%, 17.4% to be precise. So housing loans continue to grow, and there are various reasons for that. One is of course, the pent-up demand, because 2020 and 2021 there was hardly any sale of housing loan. There was increase in inventory but no sale. So those households that had postponed their buying activity, they started to buy houses in 2022 and 2023.
It's continued.
It is continuing. Yeah, it is continuing. So that is one step. The other is that the trust deficit that was there pre-COVID due to the delays in housing deliveries, all of that was addressed due to regulatory interventions through the Real Estate Investment Act. So after that, there has been improvement in the timely delivery of houses. So that has also prompted people to buy houses. So that is another reason. And another reason is also that the government's infrastructure push that has also given demand, has also supported the demand for affordable housing. houses. So these are some reasons for housing demand. But another reason, which is a very important reason that has come up post COVID, is related to our exports.
Okay.
So, for example, we have seen that it's the export of services that is the main driver,
Right.
and that has helped in bridging India's current account deficit. Now, within export of services, also there is this the services component, like legal services, management services, consultancy services, that have picked up. Not
the other
so much.
business services.
Other business services,
Right.
yes. In the balance of payments, it is the terminology is other business services. So if you look at the data, there has been a sharp increase in this in the post-COVID years. There has been outsourcing of business activities from big conglomerates in other countries to India, given India's talent, skill set, English-speaking population. So all of that has given a good generation of good quality jobs in the services sector. Now it is these people who have got jobs that they are demanding houses. So they are a big major source of demand for houses. So services exports, rise in services exports, other business services, global capability centers, people who are working in those areas, they have got good incomes and they want to buy houses, they want to upgrade their houses. So this has generated a major source of demand for housing loans. So export of services and housing demand for housing, there is a kind of strong correlation between these two variables as well.
Right, but so now we are kind of seeing indications that services exports also might it won't contract, but at least the growth will start slowing, because the destination countries, Europe, the US, they are not importing these services to the level that they used to. Do you think that this is going to have an impact, could have an impact on credit to the housing sector?
Yeah, to the extent that the demand for housing loans is being generated by this population subset that is getting incomes from the spurt and services exports. To that extent, yes, we could see a slowdown in housing demand. But if we look at some of the reports by real estate consultants, they still project housing demand to be quite robust in FY25 as well.
Right.
And also, there is another trend that we are seeing is that there is a move towards luxury houses. So, luxury houses are those that have value of more than 10 million rupees. So, there is a trend towards upgradation, move towards luxury housing from mid-level housing. There is a move. So, there is an increase in the demand for big ticket housing loans as well. So, there are both these factors playing. But yes, we have seen that even in FY24, services exports have slowed down. Of course, on a higher base, but there has been a slowdown. So to that extent, we could see some slowdown in housing demand. But there are other factors that could still support the demand for housing and therefore the demand for housing credit.
No, absolutely. This, I think it was maybe today or yesterday that there were these full front page ads by DLF saying that we've sold out one of our more luxury properties. And the thing is that they had opened the sale just 3 days before, and they were completely sold out. And I think each property was something like upwards of 6 crores.
Yeah, and so that is reflected in the inventories also. There was a time pre-COVID when the inventory overhang used to be at very high levels. Now inventory of housing has gone down because even the demand is outpacing the supply of housing.
Right.
So there is a structural dynamic shift happening in the housing segment, and that is generating a demand for housing loans. So we are seeing a credit boom in housing segment.
Right. And now you mentioned credit to industry. Now credit to industry, and especially to large industry, has been slow in the past, and it's raised the concern that, the private sector is not borrowing to invest. But in this last financial year, for which we have data, has there been some sort of reversal? You've indicated that things have turned around.
Yes. So credit to industry was slowing down, particularly post-COVID, because there was a trend towards deleveraging.
Right.
So because the companies had borrowed a lot and they had to repay because investment demand was lower, consumption demand was lower. So they preferred to repay their loans and not to take fresh loans.
Right.
So there was this tendency of deleveraging, and that deleveraging cycle is now mostly over, and therefore we are seeing a pickup in credit to industry, not to a very large extent. There is from at least the second half of FY24, the financial year that just ended, we are seeing a pickup in credit to industries. Large industries. So we just need to see whether this trend is sustained, or this trend is just is a short-lived phenomenon, or is it sustained. But if we just compare overall credit to industry in FY24 with FY23, there is a significant increase. Credit to industry grew at 8.5% in FY24,
right,
as compared to 5.6% in FY23. So there is an improvement, but still, if we see what are the major drivers of bank credit, it's still personal loans and services.
of course.
And also in terms of share, what is again a very perceptible change that we are seeing is that the share of industry in the outstanding credit has gone below that of services and personal loans,
which means the others are growing faster.
Growing faster. So the share of industry has even gone down. So while there is an increase, as I said, personal loans and services are growing faster. So their share has risen, and the share of industry in the outstanding bank credit has seen a decline.
Okay, and I'm guessing that the data that I also looked at from SEBI was the raising of capital from the markets.
Absolutely.
And even that has been growing. Like companies are increasingly raising more money from the market. So these are all kind of good signs.
These are good signs, and also even if we can't just look at funding of companies through banks, because they a large chunk of this set of companies will go to the bond market. In fact, large companies or large industries would prefer to go to bond market, and it's the MSMEs or small companies that would prefer to borrow from banks. So there we are seeing that there has been a sharp pickup in bond issuances in FY24.
Right.
Even the commercial paper, which is the short-term borrowing by companies, that also picked up in FY24, and it's expected to be sustained in this financial year because the cost of borrowing is going to become competitive. Because we know that corporate bond yields are benchmarked to government bond yield,
right,
and given that government bonds are going to be included in the bond indices, the EM bond indices, the international ones, so that will see a flood of capital coming into the government bond, lowering of bond yields, and therefore lowering of corporate bond yields. So companies would like to take advantage of this competitive interest rate structure to borrow more from bond market rather than from banks. So if we just see that the credit pickup from industry hasn't been to a great extent, it also is denoting that companies are going more towards the bond
market.
Yeah.
And this inclusion into the international, it's June this year?
June this year. So that is why there is this also expectation that rupee will appreciate to 82 per dollar, because there will be an influx. It's going to be a one-time flow, and then further it will depend on how fiscal health of the country, fiscal discipline, transparency, all those things will matter. But yes, there is going to be a one-time flow of 25 to 30 billion dollars, which would bring down government bond yields, and which would make corporate bond yields also more competitive.
Right. And now another source of concern has been the very rapid growth in unsecured lending.
Absolutely.
And even the RBI has set curbs on it and asked banks to go easy. Have they gone easy? Does the FY24 the data show that unsecured lending has started to slow down?
So if we look at personal loans, and in personal loans there is an unsecured component and secured component. While RBI does not give this breakup of unsecured and secured, we can infer that there are some components which are unsecured, like credit card exposure is one, consumer durable loans for consumer durable is another. So within this, what we have seen is that it is the credit card exposure of banks that has grown at a sharp pace, and the restrictions that were only imposed in November, towards the end of November. But till now, we don't see a very significant impact of those restrictions on the bank's exposure to credit.
But it might play out.
It might play out in the coming in this financial year. So if we look at the incremental flow of credit that has gone to these credit cards, it is 500 billion rupees. So it is quite huge, and
Right.
it's happening. This is again a trend that we are seeing in the FY23 and FY24. In each of these 2 years, we saw that the incremental credit flow to this category, that is credit card exposure, that grew by more than 500 billion rupees. And in fact, now therefore the share of credit card exposure of banks in the total personal loans has also increased to almost 5%. So this used to be a very small component, but it is growing, and therefore RBI has been rightly concerned about it and has imposed, first started giving warnings and then imposed increase in risk weights to curb banks lending to unsecured components and also bank lending to NBFCs.
Right, and now we come to the key question, the one that we sought to address right at the beginning, which is, at what point do we say that there's too much bank credit being given out, and how do we measure something like this?
Yeah, so this is a very important policy question for the central bankers, as you rightly mentioned in the beginning, that, in early 2000s, we saw this playing out. 2003 to 2007, credit growth was galloping at 40%. And then there came a phase when that turned into increase in NPAs. So there is a important need to keep a watch on the credit growth. And what are those metrics to assess whether credit growth is adequate or it is excessive? So there are these, one very simple metric is credit to GDP ratio.
Right.
That is as share of the size of the economy, what is the credit growth? And there we see that, again, if we look at the trajectory of credit to GDP ratio, it rose from 2003 to 2008, which is a recognized period of great Indian credit boom. And then after the financial crisis, it remained static at around 50%. And then during COVID time, there was a temporary pickup, mainly because of the decline in GDP. That gave a support to this ratio. But now from 2022 onwards, particularly from the second half of 2022, we are seeing that this ratio is rising. It hasn't reached any alarming levels, but the thing is that this is something to watch out for, because...
So where is it right now? Around...
It is 55%.
55%.
So there is a kind of a trend reversal. It grew from 2000 to 2008, then it remained static, it fell. Again, during COVID, it rose, again it fell, and from 2022, it has been rising. So there is a trend reversal. The declining trend has reversed, and we are seeing a rise in credit to GDP ratio.
Something to keep an eye on.
Something to keep an eye on. And the other metric is credit to GDP gap. This is something which is very important, which is pioneered by Bank for International Settlements. And this is nothing but, the deviation of credit to GDP ratio from its long-term trend. How far is your actual credit to GDP ratio from its long-term trend? So if it is 10% above its long-term trend, this ratio, if it rises 10% above its long-term trend, there's something to worry about. That means it's abnormally high. And then some regulatory restrictions kick in, like counter-cyclical capital buffers. Means that banks have to keep certain amount of capital as provisioning to address the indiscriminate lending, to restrict the indiscriminate lending. So these are two important indicators to assess whether there is a overheating happening in the economy or not. And if we look at these numbers for India, we do not see any overheating as of now, but we are seeing a trend reversal. Both these indices, both these indicators were declining, and now they are starting to rise, and they have risen now for consecutively 5-6 quarters. And this is something to keep an eye on.
So the credit to GDP gap, if it's above 10% over the long, if it's above 10%, then that's a sign of worry. So where are we now?
We are below zero. We are still negative.
It's reversed.
It's reversed. So our credit to GDP ratio is still below its long-term trend, and therefore the credit to GDP gap is negative. But it is inching towards the zero mark, and therefore then it will rise.
Become positive.
It will become positive, and it was positive during the initial 2000s period when it was 10%. It was
Right.
9 to 10%. So we are moving. So there till now we were in a period of weak credit growth. Now we are in a period of improved credit growth. Our financial cycle, to be precise, it is picking up, and therefore something to keep an eye on. And therefore all these regulatory restrictions, they are preemptive and steps in the right direction.
Right, and so now we have a question from Sankalp. It's a long one, but I think it's important to ask. He says, according to the World Bank, India's domestic credit to the private sector at 55% of GDP in 2020 is well below the world average, which is 148%. It was in that time, and lowest amongst the Asian peers. None of our macro indicators or bank performance ratios appear to be stressed, and demand is still a source of growth. More importantly, he says it's not like credit card loans are very large or they amount to Vijay Mallya levels of loans. So where is this skepticism coming from? Won't the RBI be killing jobs and growth and the remarkable performance of the NBFCs if it strikes down with a regulatory hammer?
So what is important is to look at the composition, whether this credit growth is coming from industry or services or household.
Right.
And so if we look at what is happening now as compared to what happened in the early 2000s, during that time, the growth was driven by industry. It was the industrial credit, infrastructure credit that was rising at a sharp pace. Now it's being driven by leveraged households. So what is important is to know whether households do have the capacity to repay loans back or not, and will it lead to another wave of NPAs, this time from household and not from industry. So the question here is not of killing jobs or investment, but here what is important is to understand what is the composition of bank credit, what is driving that, and whether the people or the households or the entities that are borrowing, do they have the capacity to repay, and therefore adequate safeguards are being only imposed on the unsecured component or not on the secured component.
Right.
So right now whatever restrictions are being made, they are only on very focused set of loan components.
Okay, and we have another question from Sunil, who asks, how is India's credit situation in comparison with developed nations like the US? And is growing credit a reason to worry, or is it a good thing that more people are using credit facilities via banks rather than relying on unofficial money lenders?
Absolutely. So if we look at where does India's credit to GDP ratio stand in comparison to other countries, so World Bank, like Sankalp has pointed out, this a very important database, which is domestic private sector credit to GDP ratio.
Right.
And there, if we look at the US, this number is more than 200%. Domestic private credit to GDP ratio.
Right.
But when we say domestic private credit by banks to GDP ratio, the US number is comparable to India. It's around 51%.
I see.
So which means that banks are not the major source of lenders in the United States. It's the non-bank lending which is more prominent. In contrast, in India, we are a bank-led financial sector economy, and there our overall ratio, which is private sector credit to GDP and private sector credit by banks to GDP, it's more or less same. Whereas in the case of US, there's a difference because banks is a very small component of the overall lending.
Right.
So having said that, the other question, it's very important, credit is very important, particularly for MSMEs, micro, small and medium enterprises that rely on informal sources, and we need to move towards formalization of credit for MSMEs. There are various estimates to ascertain what is the credit gap being faced by MSMEs, because they play a pivotal role in the economy in terms of employment generation, exports. So they do need access to formal credit, but there is even now there is a credit gap of 25 to 30 trillion rupees that MSMEs face.
Right.
And these are just very conservative estimates. They may be facing much more in terms of credit gap, because
by definition it's not in the organized space, so you can't exactly tell how much.
So based on the number of MSMEs and some calculations calculations, we arrive at this number that there is still a credit gap. So this is something where we need to allocate credit. So again, what is important is the composition of bank credit, where it is going. It is important to allocate credit to small entities, to MSMEs that cannot access the bond market, whereas large industries can access bond market. Even in other countries, the small entities are more comfortable with banks because there's a personal relationship with banks, so it's more easier to access loan. So the policy priority has been, we have seen during COVID time also, there was this entire focus on credit to allocation to MSMEs.
Yes.
So that agenda needs to continue, but at the same time we need to be mindful of when this credit becomes overheated in terms of the various metrics. So that we've spoken about credit to GDP ratio and credit to GDP gap, that if they are turning towards positive territory, have they reached a level which would be a cause of concern? Because RBI also has these guidelines. If we look at these guidelines, if this credit to GDP gap becomes above 3%, RBI starts to monitor and it imposes certain restriction that you have to keep certain amount of capital as a percentage of your loan, and that amount of capital rises as your gap becomes more positive.
Yeah.
So these are very important metrics that need to be monitored, particularly at this level where the aggregate credit growth is growing in double digits, and at the same time the composition of bank credit has to be taken note of.
Right. So there you go. The basically overall bank credit in FY24 has grown strongly. It has grown stronger than before for large industries, which is a great sign. The overall share of large industry, the credit to large industry has fallen, but that's because credit to other areas has grown even faster. So that's personal loans and services. Now, personal loans, of course, housing loans has been growing very, very fast, but a little sign of worry is that the unsecured loans have also been growing very fast, despite the RBI putting down some clamps on it. The clamps came in November, so maybe that effect isn't being felt just yet. Hopefully, it'll start being felt a little bit down the line, but it's still something to keep an eye on. The other thing to keep an eye on is that there are some key ratios that we look at to see whether the amount of credit in the economy is too much, is it tending towards a risky amount, and those metrics are showing that yes, the direction has changed. It is moving in the direction where in the future it could become something that could worry us. So now is the time to keep an eye on it, but it's not alarming yet. But on that note, that's all from us. Thank you so much for watching.